Hi everyone, so let's now take a look at the money multiplier. So when it comes to the money multiplier, this really helps us to understand how an initial bank deposit can lead to much larger increases in the total money supply. So if I deposit £10,000 of cash into my bank account, well, the bank may take £9,000 of that and actually re-lend it once again. Part of that money may be retained in another person's bank account, and part of that money may be re-lent once again, and so on and so on. So therefore there can be larger increases in the total money supply as a result of that initial bank deposit. Okay, now this money multiplier is really a key feature of the fractional reserve banking system that we have in operation in the UK. And this relies upon a reserve requirement ratio. And the reserve requirement ratio is the percentage of deposits the banks need to actually keep in liquid reserves. So imagine that reserve requirement ratio could be 10%. If that's the case, out of every £100 that's deposited, it means £90 can be re-lent, but 10% must be retained in the banking system. This gives the Bank of England the ability to actually determine what is the most appropriate reserve requirement ratio based upon what they want to happen to the money supply. Okay, so let's just take a look at this. So with our money multiplier here, we can see it's just 1 divided by this reserve requirement ratio. Okay, so let's now consider that actually we're working perhaps to a 20% reserve requirement. That would mean that I would then divide 1 by 0.2, and that would give us our money multiplier value of 5 here. Okay, so let's just consider each of these scenarios here to make sure we understand the way in which this would then work. So what is the impact of £100 million of bond purchases by the Bank of England at 20% reserve requirement ratio? So imagine now that the Bank of England is actually making those bond purchases through quantitative easing. It's creating brand new money which is being introduced to the money supply, and we've got this 20% reserve requirement ratio. That money is being given to the bank, so what will happen? All we need to do, because this is brand new money that we have introduced to the money supply, is 100 million times 5. That will tell us that we can therefore anticipate a increase to the total money supply of £500 million here. Okay, in our next example we can see Fred deposits £1,000 into his bank at a 20% reserve requirement ratio. So if Fred deposits £1,000, well, this isn't new money. It's not like the example we just saw here. So this is not brand new money. This money is already part of the money supply. So therefore we've got to remember that part of this money will actually need to be retained as part of that reserve requirement ratio. So yes, we can start off by multiplying 1,000 by 5. That of course gives us £5,000 there. Okay, but we must remember out of that £5,000 we need to retain a 20% reserve requirement ratio. So if we retain that 20% reserve requirement ratio, then we can see that there will actually be an increase to the total money supply of £4,000, which can be re-lent to the real economy. Okay, great stuff. Now, the only thing that you just might want to think about is what might happen to these answers if perhaps you went for a 15% reserve requirement ratio. If you go perhaps for a 10% reserve requirement ratio. By doing so, you'll be able to actually understand the impact that the Bank of England can have by governing what level of reserve requirement the banks in the UK should actually have. Okay, this gives them big influence over the actual money supply that's created. All right, thanks guys.